Chapter 2, Charts. Charts are the working tools of the technical analyst. They have been developed in a multitude of forms and styles to represent graphically almost anything and everything that takes place in the market, or to plot an index derived therefrom. There may be monthly charts on which an entire month's trading record is condensed into a single entry, or weekly, daily, hourly transaction, point and figure, candlestick, etc. They may be constructed on arithmetic, logarithmic, or square root scale, or projected as oscillators. They may delineate moving averages, proportion of trading volume to price movement, average price of most active issues, odd lot transactions, the short interest, and an infinitude of other relations, ratios, indexes, all technical in the sense that they are derived directly or indirectly from what has actually been transacted on the exchange. With most of these, fortunately, we shall not need to concern ourselves at all. They are of interest only to the full-time economic analyst. Many of them have derived from a completely futile, so far at least, endeavor to discover some one mechanical index or combination of indexes which will always automatically, without ever failing or going wrong, give warning of a change in trend. Such, in our experience, are often confusing and sometimes downright deceptive at a most critical juncture. This book, however, is designed for the layman, the business or the professional man who cannot spend all his hours on his investing and trading operations, but to whom these operations are nevertheless of a sufficient importance or interest to warrant his devoting at least a few minutes a day to their study and management. The theories and methods outlined herein will require only the simplest form of stock chart, a record of the price range, high and low, closing price, and the volume of shares traded each day. These daily graphs will be supplemented for certain purposes, which will be discussed further on, by weekly or monthly charts, which for most stocks can be purchased ready-made, which are easily generated by almost all commercially available investment software. Nearly all the illustrations throughout the following pages are examples of such daily charts. They are easy to make and maintain manually, requiring only a supply of graph or cross-section paper. Almost any kind can serve. A daily newspaper which gives full and accurate report on stock exchange dealings, a sharp pencil, and a few minutes of time. It is customary in preparing ordinary daily stock charts to let the horizontal axis represent time with the vertical cross lines, or as some prefer, the spaces between them from left to right, thus standing for successive days. The vertical scale is used for prices, with each horizontal cross line then representing a specific price level. Space is usually provided at the bottom of the sheet to plot volume, that is, the number of shares which change hands each day. The newspaper publishing complete stock market reports give the day's turnover or volume, exclusive of odd lot transactions, which may, for our present purpose, be disregarded. The highest and lowest price at which each stock sold during the day, the closing price, which is the price at which the last sale effected during the day was made, and usually the opening or first sale price. On our charts, the daily price range is plotted by drawing vertical lines connecting the points representing the high and low. Then a short horizontal tick is added, either crossing the vertical range line or extending out to the right from it at the level of closing price. Sometimes all transactions in a stock during a day take place at one and the same price. The high, low, and close are thus all on a level, and only mark on our chart will then be horizontal dash representing the closing figure. Volume is depicted by drawing a vertical line up from the baseline of the chart. The opening price need not be recorded. Experience has shown that it seldom, if ever, has any significance in estimating future developments, which is all that ordinarily should interest us. The closing price is important, however. It is in fact the only price which many casual readers of the financial pages ever look at. It represents the final evaluation of the stock made by the market during the day. It may of course be registered in the first hour of trading, provided no other sales are subsequently affected, but it becomes nevertheless the figure upon which a majority of prospective traders base their plans for the following day. Hence, its technical significance, which will appear in various contexts in later chapters. Different types of scales. Many specific suggestions as to the details of charting are deferred for discussion in the second section of this book, but there is one chart feature which may well be considered here. Until recent years, nearly all stock price charts were kept on the common form of graph paper, ruled to what is known as plain or arithmetic scale. But more and more chartists have now come to use what is known as semi-logarithmic paper, or sometimes ratio or percentage paper. Our own experience indicates that the semi-logarithmic scale has definite advantages in this work. Most of the charts reproduced in this book employ it. The two types of scale may be distinguished at a glance by the fact that on arithmetic paper, equal distances on vertical scales, that is, between horizontal lines, represent equal amounts in dollars, whereas on the semi-logarithmic paper, they represent equal percentage changes. Thus, on arithmetic paper, the distance between 10 and 20 on the vertical stage is exactly the same as that from 20 to 30 and from 30 to 40. On the logarithmic scale, the difference from 10 to 20, representing an increase in 100%, is the same as from 20 to 40 or from 40 to 80, in each case representing another 100% increase. Percentage relations, it goes without saying, are important in trading in securities. The semi-logarithmic scale permits direct comparison of high and low in price stocks and makes it easier to choose the one offering the greater percentage profit on the funds to be invested. It facilitates the placing of stop loss orders. Area patterns appear most the same on either type of paper, but certain trend lines develop more advantageously on the ratio scale. Almost anyone can quickly become accustomed to making entries on this semi-logarithmic paper. We recommend its use. However, its advantages are not so great as to require one to change. One who, because of the long familiarity with and practice, prefers an arithmetic sheet. Such percentage calculations as may seem to be required can only, after all, be made on another sheet or in the head, and results then entered on the arithmetic chart if a record is desired. Several firms specializing in the manufacture of graph paper and other engineers and architects supplies now offer sheets specifically designed for stock charting, on which heavier lines to define the business week mark its sixth day on the time scale, and the price scale is subdivided into eighths to represent the standard fractions of the dollar in which stocks are traded on all American exchanges. These sheets are available in various sizes and with either arithmetic or logarithmic price and volume scales. On weekly charts, each vertical line represents a week's trading. The price range for the week is plotted thereon, and usually the total volume, but the closing price may or may not be omitted. The range extends, of course, from the highest price at which the stock sold on any day during the week to the lowest price at which it sold on any day. These two extremes might and sometimes do occur on the same day, but the weekly chart makes no distinctions as to the day. Monthly charts are prepared in the same way, but do not as a rule record volume. These two, often referred to as long-term or major charts, are used chiefly for determining important support and resistance levels, marking long-term trends. Weekly charts, if the reader prefers to keep his own, can be posted easily from the Sunday morning edition of those newspapers and publish a summary of previous week's transactions. In concluding this chapter on the construction of charts that we shall study in the succeeding chapters, it can well be said that there is no special virtue, certainly no magic, in the chart itself. It is simply a pictorial record of the trading history of the stock or stocks in which we may be interested. To the man possessed of photographic memory, no chart work is necessary. His mind records all the necessary data. He carries his charts in his head. Many of the expert tape readers who have no use for charts are gifted with that rare memory talent which renders reference to graphic records unnecessary, but most of us are not so blessed. To use the chart is necessary and useful because it lends itself conveniently to the type of analysis which indicates future probabilities. There is a saying on Wall Street to the effect that there is nothing wrong with charts, the trouble is with the chartists, which is simply another way of expressing the truth that it is not the chart itself but its interpretation that is important. Chart analysis is neither easy nor foolproof. Yet, it is not at all uncommon for some casual investor who has no idea whatever on market techniques to pick up a chart by chance and see in it something which he had not hitherto suspected, something perhaps which saves him from making an unfavorable commitment. If you have never used stock charts, never paid much attention to them, you may be surprised at some of the significant things you will quickly detect as soon as you begin to study them seriously.